Well, welcome back, everybody. Good to see you. We've got another good turnout for our beginning of our global presentation on catastrophe resilience. And we've had a great session so far, and are thrilled to be able to offer up our next presenter, Jerry Skees, who's from the Global Center on Disaster Risk and Poverty. And Dr. Skees is a founder of Global Parametrics, and it was a private company that's based in London that manages disaster fund with a focus on emerging economies. The British and German governments provided risk capital for the NDF to focus on developing countries. Skees served as founder and director of the Global Center of Disaster Risk and Poverty, where he's leading a global initiative and collaboration with the chief economist of the Food and Agriculture Organization, the FAO. Financing the shock-driven food crisis is another one. Dr. Skees brings extensive experience spanning academia, government, and the private sector, beginning way, he says early 2000s. Before that, even, he led some major projects, I know, in Mongolia, Peru, Vietnam, Indonesia. He's had the support of the Gates Foundation, and he and his PhD students developed the world's first forecast insurance for extreme El Nino events, helping to mitigate flood risk in northern Peru, and inspiring what we now know as anticipatory action programs that use forecasts and early warnings to take actions before disasters occur. So, Jerry, you were into parametrics before parametrics were cool, right? So you started a lot of these index products. So we're thrilled to have you here, and I think you've got even some former students on here. So please take us away. We'll kind of widen the lens here for us in looking at what we can be doing in terms of catastrophe resilience globally and how parametrics have a role in that, especially in developing countries.
Okay, thank you, Jim. Can you hear me okay? Can you see the PowerPoint?
And you do need to click the share button in the bottom of the Zoom window.
I can hear you.
All right. There's another process to be followed, hey? Let's see.
Just pick the PowerPoint.
Yeah, here we go. Does that look more promising?
And it looks like it's still loading. I'll give you a confirmation. There we go. And then go ahead and put it into full screen mode. It's in your slide sorter view right now.
Okay.
Perfect. Looks great. And I'll be ready to share your video. You just give me the go when you're ready for that.
All right. Well, thank you. It's great to be here. And it's interesting. I caught the tail end of happenings in Florida. Everybody watches Florida, the whole world, including, by the way, a nice case was made when we were setting up the Natural Disaster Fund with the British government that we could actually hedge some of the emerging market risk, because Florida has this interesting phenomena that as El Nino comes, which has a big impact in the rest of the world, you have a softening of tropical cyclones, hurricanes in the Atlantic basin. So it's in fact, it's negative correlation, which is kind of a rare thing. Just to add a little spice to the former conversation that was taking place. In other words, if we had enough emerging market risk, we could make Florida wind a little more affordable, I would say.
That's a cool idea. We're gonna write down that question. Thanks, Jerry. That's a great idea.
So I don't want to lose sight of that opportunity to just punch in there and say that. I don't think anybody on the call would need to be persuaded that catastrophes impact the developing countries and the poor and vulnerable the most. This is the whole case we made when we were working with the British and the German governments to build global parametrics. You know, the protection gap, by far, these markets are just not present. Insurance markets in emerging economies, low and middle income countries, there's a great need for this type of protection. When we start putting it into a context, one of the things that I'm always reminding people is I'm not an insurance salesman per se. I'm really much more about disaster risk financing and where does parametrics fit into that matrix. So I don't want to lose sight of this particular slide. You know, on the right-hand side, you have what typically happens in emerging economies because they don't have the maturity of markets that are on that left-hand side with the ex-ante instruments, insurance, and other, even contingent credit, reserve funds. All of these things are a lot of times missing in the emerging economies. So you end up with discretionary post-disaster relief, humanitarian, tax increases, you know, all these really draconian ways of coping after a disaster. So that's a big part of the story that kind of gets us into the transition from the developed world into the emerging economies. And all you have to do is look at the history of insurance in the developed world to appreciate how much sophistication has taken place. And I'm a public policy economist first and foremost. I'm not an insurance guy first. I'm an insurance guy now, but it was because I was motivated by the opportunity for public policy. So when you think about the institutional structure of what's happened in developed countries rather, you've got the sophisticated banking systems that have been in place. Banking and insurance regulations have been there to facilitate these developments. And I dare say that in many emerging economies, that institutional infrastructure is simply missing. So you end up with even more dire consequences of a catastrophic event when it impacts an emerging economy. As an economist, the other thing I always think about is what's the cost of capital? What are the consequences of these types of shocks on the cost of capital? And there's been some good work done on this, and that more work's needed to try to assess what the cost of capital, and what you see in this little box is climate risk alone have probably added 100 basis points to the cost of capital. And that's in the low income countries. That's pretty dramatic. We estimated in Peru, northern Peru, we were working on extreme El Nino, which created quite a bit of disruption in that economy. And we estimated it was 200 basis points. And this is looking back. Unfortunately, looking forward, we have more extreme events, more conditions that are going to create more problems. The work we did in Peru, I had fantastic PhD students involved with me. We got really into the records of the financial institutions. We started to model. We appreciated very much that the disruption of a natural disaster that impacts a large part of the portfolio has this problem that you're having a growth trajectory. Boom, here comes a disaster. You have to tighten your belt. You have to slow lending at the minute that your clients need it the most. And you end up with this pattern of growth, a disaster, no growth. So this basic graph is meant to kind of motivate the regulator, the policymaker, that if you can get protection, you're going to be able to have a business interruption that will allow that economic growth. And I dare say this is financial institutions, but I think it's going to be true for any type of business, is this kind of seesaw pattern, if you will. So that's a lot of research could be done to kind of validate that, get records, understand more about this in the context of emerging economies. It's needed. We need more evidence. Every time we need more evidence. This market's mature. I'm the old guy. I was around in 1988 when Chubb tried to do this in Illinois. They tried to do rainfall insurance. Guess what they did? The farmers were buying it and they loved it. And Chubb extended the sales closing date. Well, guess what? The farmers knew a drought was coming and Chubb didn't have the resources to pay. So that was kind of the big setback in parametric insurance in the 1980s in the United States of America. We did something with the U.S. crop insurance program. We did an area yield insurance in 1990. A team, it was done from the University of Kentucky. It was one of the first products built for the Federal Crop Insurance Corporation that was outside the government. And we did it, of course, in strong collaboration with government. But that particular episode in my life put me into international development, and I never looked back. Now, there's been a lot of things that have been done that I hope you have some history of. If you think about the small island states in the Caribbean, a tropical cyclone, earthquake hitting Haiti, the capacity is not there, and the interest from the reinsurance markets was not there. The pricing was really quite dire, and the World Bank was actually supporting the idea of risk pooling, and they set up this CRIF, the Caribbean Catastrophic Reinsurance Facility, and we did something similar with ARC. I was kind of in the early stages of doing some of that initial research for ARC. These are really punctuation points in terms of development and insurance markets in small country states that have this concentration. It helped me think about what we could do with risk capital that would be dedicated to the ODA countries, if you will. And so that was the motivation for the Global Parametrics to be a fund manager for capital that was provided by the British and German government. And in that case, we were pooling risk around the world and trying to demonstrate that we could actually take an initial investment from a donor and make it last for 30 years. And I'm proud to say that on Friday of this past week, I was in London celebrating, and the Natural Disaster Fund has now got $100 million of capacity that's fully deployed, a lot of interesting programs. I think I sent around the impact report from the Natural Disaster Fund, and Hanover Re stood up in the meeting and said, we're going to put another 50 million on the table. So that means it's 150 now. It's meant to be an incubator. It's not meant to crowd the market out. It's meant to crowd the market in. Very important. All right, it's a diversified portfolio. You can see that geographically it's diversified, by peril it's diversified. I had to produce a document for the government actuary of the UK government to persuade them that we knew what we were doing in terms of putting a diversified portfolio together. And you can see that at this point, that's quite nice. When we talk about parametric products, we're talking about insuring an event with exposure, and I'll show you some more in a moment. But the most important part about parametrics is it can meet the needs at three levels: at the macro level, at the meso level, at the micro level. And I've got lots of examples of that. We see quite a bit of activity now in the world at all three of these junctures, if you will. One of the other parts that I'm always careful with is just the same way that I raise my children. You have to have savings first, you have a good relationship with the bank second, and then you turn to insurance for the catastrophic part. So the whole idea of layering is fundamentally important. I'm sad to say that sometimes we get so caught up in the parametric offer that we want to design something that works. And in order to design something that works, sometimes we get a little too much in the money, meaning that we're paying for return periods that are maybe 5 years, maybe even less. And that's not insurance. It'll demonstrate it works in terms of payouts, but it's not going to demonstrate it works in terms of value for the client. That's a bit of an editorial, but I feel strongly about it. In the parametrics, with global parametrics, we were a little ahead of our time. So we actually had to build the products. We had to build the data. If we were doing it today, there's lots of data providers that are doing this. But we built data systems. We did it so that we could actually price and settle contracts with the data. And you can see a sampling here, and you can see the type of data that we used in the weather products. we had fits and starts with using the US data, and we ended up really feeling pretty comfortable with the European data, the ECWMF data, the European Center on Mid-Range Weather Forecasting is quite a good data set, ERA5. So these data we've been using, and we see a lot of others in the world using these data now. Now, this is a noisy slide, but I want to just tease out for your thought process that the many different ways to be thinking about parametrics in emerging economies. And keep in mind, we were trying to leapfrog a lot of the development of insurance markets by introducing the idea of parametrics, because you didn't have to put the history of the insured data together. You didn't have to do a lot of the steps that had to be done in the way that insurance markets developed in the United States and Europe. That took years, decades to do that. And we needed to move faster. So the parametric approach really did capture people's attention and still does, and I think rightly so. But we can talk about any of these. Write down your favorite. Let's go to some questions and answers in a bit, and you can come up and ask about any one of these, and we can tell a bit of stories about that. I'm going to transition now and share something that was launched yesterday. I'm sitting in Rome, and yesterday we had a very nice launch for this program called Financing Shock-Driven Food Crisis, and we got a movie to share. I'm going to turn it over to you, Sandy.
Thank you so much. Here we go.
Agri-food systems are the backbone of global food security, livelihoods and economies. Yet they are increasingly vulnerable to multiple interconnected shocks, climate disasters, conflict and war, pest outbreaks, and market volatility. When these systems fail, the consequences go far beyond food, triggering loss of income, livelihoods, deepening social instability, and fueling food insecurity and malnutrition. Despite early warnings, global aid often arrives too late, sometimes after lives and assets are already lost. Less than 1% of humanitarian funding is allocated for anticipatory action, while billions of dollars are lost as food crises escalate. We need speed, an agile system with a scalable, pre-arranged architecture to deploy funds, enabling anticipatory actions and rapid response before crises spiral out of control. That's where the Financing for Shock-Driven Food Crises facility comes in. This FAO-led initiative, designed with the technical contributions of the World Food Programme and the Office for the Coordination of Humanitarian Affairs, and endorsed by the G7 under the Italian presidency in 2024, aims to bridge the growing financing gap by providing anticipatory action and rapid response financing to prevent spikes in food insecurity from becoming full-blown food crises. Anticipatory action saves lives and reduces the overall cost of emergency response. FSFC uses scientific triggers and pre-established evidence-based action plans to guide decisions and release funding ahead of forecasted hazards. It integrates FAO's Food Security Risk Intelligence and Early Warning Room at FAO HQ, which provides real-time monitoring and transparent data sharing of 12 major hazards, including insurable risks like droughts, floods and tropical cyclones, and traditionally non-insurable threats such as political instability, conflict, and locust outbreaks. This financing facility mobilizes private investment to expand risk coverage, bridging the gap between needs and available resources. It shifts away from costly emergency aid toward a proactive model that leverages parametric insurance and blended financing, ensuring timely and efficient interventions. The use of a blended finance model is to make risk coverage more affordable, scalable, and effective, particularly in contexts where traditional insurance is too expensive or simply inadequate. By blending public and private resources in this way, FSFC amplifies the impact of donor contributions, lowers overall cost, and extends protection to previously uninsurable risk, providing a lifeline for vulnerable communities. FSFC complements existing mechanisms, filling critical timing and financing gaps often overlooked by traditional funding models. By replacing reaction with readiness, delay with speed, and fragmentation with coordination, FSFC ensures that communities are equipped to face risks head-on, protecting agri-food systems, saving lives and livelihoods, and preventing crises from escalating.
Okay, thank you very much. I'll switch back over to the PowerPoint now. All right, if I can do so.
Yeah, go ahead and reshare your screen.
Very good. Is it coming up now?
And there it is. Perfect. Thank you.
All right, so we've been working on this for a couple of years now. Some of you may be familiar with the World Bank tried to do a FAM a few years ago, and this is a bit of a follow-on to that. And yesterday, Munich Re, and there's a risk monitoring room that you might want to look at too. Lots of data. You heard it mentioned in the little video. And the idea of the risk monitoring room is we're monitoring all these 12 risks around the globe. On the other side, we've got the insurance products, and we're going to basically move those uninsurable risk and the other country risk over to the insurance board. So it's a very vivid visual representation of the aspirations of the program. A lot of people have been involved in this, and there's too many people to be naming here, but I'm going to call out Pablo Soares, who was always an inspiration for me, and we really miss him in the community. But the idea here is you're going to increase the energy that's already there in a lot of anticipatory action. You're going to increase speed and agility. It's a blended finance solution. It's like I mentioned a moment ago, you don't put insurance in all layers of the risk. And the idea here is you can demonstrate that for what the anticipatory action community does, up to maybe 7-year return period, and then you have a cash layer, maybe 7 to 20, and then you have insurance for the 20 and above. We're illustrating that that's a more efficient way to do this. Of course, the idea is that we're going to have diversifiable risk, and that someday we could actually create a self-insurance fund, different than the NDF, but a self-insurance fund where retained premium would give the perpetuity of the donor money a real sustainable play. It's very much science-driven. There's a lot of thought in terms of the governance. Some of you know Tim Nylander. He's been helping us with the design of this. And of course, it's all about learning by doing. But fundamentally, this would not be possible if progress had not already been made in the anticipatory action space. And you can see here that there's a significant amount of progress on the planet with anticipatory action. I remember the days a decade or so ago in Geneva, 30 geeky people talking about this stuff. In Berlin last year, there were 600 people in the room, 1,500 people online. You see here that it's talking about underway now, 197 additional frameworks in 76 countries. So we're lining up with that community. That community's already had those discussions with policymakers, with stakeholders in the country. They have a pre-agreed set of action steps that come with the financing. And the idea for this is that we will increase the number of hazards that are covered and increase the geography. So what we did yesterday was we illustrated with 4 of the protocols exactly how this might work. Munich Re has already priced a match for these 4 protocols. There's 25 million of anticipatory action. They basically are offering 100 million of insurance protection on the backside of the anticipatory action. And that's all provided in a very thoughtful way, we hope, because it's lining up with the cash that's already there with the reserve funding of OCHA FAO's got their own sphere through the Office of Emergency and Resilience. And of course, the World Food Program has any number of these as well. So this is a basic schematic. You can see it's meant to be a multi-donor trust fund that purchases insurance. Insurance comes in the middle, and then we have cash triggers as well for uninsurable risk. It gets aggregated, and then it goes out to the anticipatory action implementers. This is the way we're going to manage basis risk. This is a very agile system to actually put blended finance into practice. Now, I'm going to give you a quick illustration. We did a forecast insurance in Peru. I presented a different thought process for Munich Re. They're considering this now. This would be about extreme El Niños. And if you look at the peaks here above that orange line, that's about a 10-year return period. Here's a structure. I'm not going to go through all the details, but I will tell you that as early as September, you're able to make a call for a contract that would be using the last 3 months of the year. And of course, it pays more based on the extreme level of the sea surface temperature, which has a direct relationship to the impact in emerging economies. FAO in 2023 lined up funding for El Nino in 24 countries, which is great. We can bring in additional funding with this. So this is one example of a true forecast insurance product. Munich Re is ready to do the track of storm for the Mozambique tropical cyclone. So you've got a real example of a forecast insurance product. The industry is hesitant to move into this space of underwriting forecast insurance. There's a tremendous amount of work to be done there. Data systems and forecast systems are going to get better and better, and we'll be able to forecast with more accuracy in the future. So having the institutional framework ready for the technology that's coming, I think is very exciting. And it's been a big part of the thought process here. So I've got some other slides here. I don't want to dominate too much of the time, but I'm going to tease out some things for you so that we can come back to your questions and we can talk about a few of these cases. We did something with the World Bank on DRC to adopt climate smart agriculture. The idea here is you build a structure. They had the premium support for this, and you protect the farmers as they're adopting the technology, because that's your asset. The adoption of that technology that's going to be more resilient to the climate. If those farmers get hurt by the climate and they run away from farming, you've lost your whole program. So it's a nice linkage to insurance that I think is really interesting, and we were happy to be involved. I'm giving you some perspective here. We work with IFPRI. We showed the relationship between a yield loss, a climate shock, and income. So we showed this very explicitly. We also showed that there's a negative trend in a water balance index for drought. You see the blue line, that's the raw data. We trend adjust it with the black line, just giving you a tease out of some ways of working on this type of program. I'm going to give you some quick views of parametrics. One of the first parametrics was tropical cyclone, wind speed, track of storm, exposure. And I know that 30 years ago, just like we heard from the previous speaker, insurance companies were modeling because they knew where their portfolio was. They knew where the track of hurricanes might be, and they were trying to model the conditions of the extreme events and how much they would suffer in terms of losses. So it wasn't like these things were being developed in a vacuum. The predecessor to weather trading markets, lots of different innovation was occurring. Catastrophic bonds in the early days were parametric mini situations. So these things are all part of that Forrest Gump journey, if you will, of watching what's going on in the world and knowing that a lot of people are doing things that really complement one another. Here's an example of a financial institution track of storm. You think about the portfolio, you weight according to the portfolio. There's cat in the box, there's intensity products, there's portfolio products. We did a portfolio with a client called Vision Fund. And what we are doing with them now is we're protecting 27 microfinance institutions with 5 perils with one single contract that sets as a derivative contract in California. And we gave Vision Fund the benefit of the risk pooling. It's something that I'm very proud of because this was meant to facilitate recovery lending programs that Vision Fund was already doing when they had extreme shocks from tropical cyclones in the Philippines. Is when I first entered into the story, because they just had high end and they went right in behind the storm and made loans. This is something that we could talk about for any major global entity. You could do this type of structure for an agribusiness. I've had discussions with ADM and others about these ideas. A lot of intrigue. I think there's been some follow-up, but it's been with bigger players in the market. That's all fine and good. I think one thing that we were hearing a minute ago is why not combine two worlds together, parametrics and indemnity products. We saw a little bit of that discussion with Alex probing that question. Why don't you think about doing the wind cover with parametrics? I think there's a lot of good work that can be done here in terms of how you move the deductible in the parametric space. And let's don't ever forget the big value of parametric insurance is business interruption without litigation, because you have clarity of a signal and when you're going to get a payment. And we hope you won't have the litigation that goes with that. So there's that. Lots of general lessons. Regulatory side has been a constraint, but I think the community doesn't feel like it's been that big a constraint. This is a survey of what people think has been standing in the way of parametric development. It's a couple years old, but I dare say that 52% hasn't changed too much. It's still an educational issue of helping a client understand the value proposition. We've learned a lot. We know that, way back when I was doing work on the psychology of risk and doing things like interviewing farmers and trying to get a view of what they think about risk. And lo and behold, they forgot the bad years. We all forget the bad years whenever we think about how we manage ourselves. And so this is still a problem. What I'm always disappointed in is that in the insurance business, it's easier to sell losses than it is to sell risk management. I think that's a problem. Clients, I mentioned this earlier, clients want that proof of concept. So we see people designing something that's going to pay more frequently. I think that's a problem. There's always this comparison between an indemnity policy and a parametric product. And boy, that annoys me to no end, because you can take an indemnity product and you could say it's a 2% rate online, but you're way out in the tail of the distribution. With parametrics, you can provide a very honest presentation, say if it's a 100-year return, this is what we're going to do, and you get a better value for money. All right, we've done a lot of work on how to do senior debt, contingent debt, parametric products for financial institutions. But let me come back to this slide, and I want to also tease this one out. We could talk about this. There is no climate insurance. Climate's a long-term phenomenon. We have weather, parametric insurance products. Very rarely do you see anything that is beyond 1 year. Occasionally, you might get 2 or 3 years. What I want you to be thinking about is how do you blend infrastructure with insurance and create an adapt process so that as you have the frequency of the thing that's going to harm the infrastructure increasing, it's giving you more incentive to reinforce the infrastructure because your insurance is becoming more expensive. I tried to get a PhD student to do this research. I never was successful. Probably it was because at that time, I was just about ready to leave the university for global parametrics. But this is still a real fundamental piece of research to be done, trading off concrete for risk transfer. So let me stop with this slide and open it up for questions. Hopefully I haven't gone too fast.
Oh, Jerry, that was great. Let me back up a little bit for everybody, make sure we're all on the same page here. So we get parametric insurance, which is based on a trigger. It could be, I think originally they had rainfall, and then it got into satellite imageries and things like that. What are the triggers that you would examples of triggers that you're going to see with anticipatory action? Let's make sure everybody understands what we're talking about, because this is you're getting the funds triggered before the loss happens. So tell us about what would be some good examples of anticipatory action triggers that would give you.
So in Peru, I had the value of a Gates Foundation grant to work in Peru. And I had really smart PhD students as well, which is always nice. So the combination helped us understand a little bit more about what was happening in real time and historically, how the community had responded whenever they saw this strong El Nino, because El Nino is Peru. Everybody knows what's going to happen in the northern part of Peru because the ocean's temperatures warm up, the warm air comes in, meets the cold air coming off the Andes. It rains, it rains, it rains in places that are typically a desert. My PhD students found the records of the financial institutions where they were making adjustments before the flooding in their reserves and restructuring loans. So when we said with the regulator, we said, this is business interruption. Your community is already making adjustments, incurring extra costs and making adjustments to get ready for something that's going to happen. As we went out in the community and we started having stakeholder workshops, it was the obvious thing. If you had money before the flooding occurred, what would you do? People were talking about things, simple things. We're going to clean out the drainage systems because this is a desert. Nobody pays attention to the drainage systems. But if we had the money, we'd hire the dozers, we'd clean out the drainage system, we'd get ready. There was a fishery discussion with anchovy. So, it helped open my eyes. Discussions we had then with a lot of different people in the humanitarian community. Wouldn't it be nice if you could do this with no regret? You could act. So I gave you an example with the El Nino again that would pay well before the impact with that INSO 3-4 structure that I showed a minute ago. So there's a data set that's ready available. This is ready to go. Now, what we've done in Niger, with a climate scientist that I work with, we try to see if the 14-day forecast from ECWMF had additional information so we could advance the payments even sooner for the flooding that might occur. I think there's a lot of promise in that area. We were seeing some reasonable results from that. So what's important here for the insurance sector to converge with the anticipatory action community is to be thinking about dual triggers, if you will. So back to the example I gave you a minute ago, Mozambique, Munich Re has two triggers. They've got a track of storm, which is a forecast, and then they have another trigger when it actually makes the landfall. Of course, remember, when it makes the landfall, you're going to pay much faster than any traditional insurance because you've got the information straight away. But, stacking those kind of things together becomes part of that story. As I say, we're going to see more improvements in forecast. I hope the US will continue to invest in this area because we've been a leader. But certainly the Europeans are continuing to invest. So if you imagine that those forecasts can help you anticipate drought conditions, flooding conditions, tropical cyclone, you can put not only the anticipatory action cash in front of it, but you can add insurance when you see that it's reaching those catastrophic levels. Does that answer your question, Jim?
It does, and I think I want to make sure everybody understood what we were talking about with antis, because it's something that is not always common within the industry, especially now. Parametrics is something that some people are just now learning about. So talking about anticipatory action is might need a little clarification. So who is the best policyholder or the best recipient of this kind of financing? Is it individual businesses or farmers, or is it at the more of a middle level, meso level with microfinance institutions or banks, or is it the governments? Because you had several examples of where anticipatory action could be used, and you mentioned that the farmers, the individual farmers forget about the bad years. Probably not the microfinance institution, probably not the government. So who's the best one to purchase purchase this product if we have this as an insurance product?
Okay, so I'm a policy economist first.
Right.
So I always want to frame the problem.
That's always good.
What problem are we trying to solve, right?
Right.
And we've just doing that, as I always told my PhD dissertation students, until you frame the problem, I'm not going to set you free to do the research, right? You've got to get the problem framed in a very coherent, clear way. So framing the problem and trying to understand who the stakeholders are that are going to have the most disruptions from these extreme events, I think has to be the starting point. Trying to know who the stakeholders are that are trying to be in that space, what types of actions they want to take, where their financial constraints are. All of that's fundamental in framing the problem. I started by thinking that we could do this for farmers at the micro level with weather index insurance. I still applaud people that are pushing in that direction. I decided to put my energy in a different place because of a variety of conclusions that I reached. They may be wrong today because there's been advances, but as I was trying to do that work, I could see a tremendous amount of basis risk. I could see a lot of effort to try to reduce the basis risk with the way you structured, the way you tortured the data. Let's just call it tortured the data in some situations. And I never was quite persuaded that the basis risk was being managed too well. But there was also that puzzle of if you're living on the margin, you're giving up some cash to pay for insurance, is that going to help you or is it going to hurt you? Because those are your cash reserves that help you with managing your household livelihood. I think one of the mistakes we made early on is we tried to mimic crop insurance. I wished we wouldn't have done that. I think we would have been much better off in the developing world had we framed that problem as one of household livelihood and business interruption for the household livelihood. And then I think we could have made a little more progress, frankly, because we wouldn't have gotten so fixated on, does this really correlate with crop yield? So there's that. But as we moved along, and in particular with the work in Peru, we started working with the microfinance institutions because we saw their behavior. They were the ones that were incurring the extra cost. And we actually got a microfinance institution to purchase the product for a couple of years. And they did it for purpose. They did it so that they could expand lending in the northern part of Peru. That's a financial access story, right? And we were real happy with that. It was a little before its time, and the world wasn't quite ready for it, I'm afraid. But the world's ready now, and there's more opportunities like this. And I hope that the young people here can be inspired by some of these crazy ideas. They're not all crazy. You can make this stuff happen.
Not at all crazy. And I looked at the kind of lessons learned and the examples you have, possible applications out here. And I think, all of these have very interesting possibilities. But I think what you said there at the end is something they really need to know is it's holistic. It's not just a crop, right? It's really focusing on, for example, I talk to the farmers like you have. It's like, I don't need, a crop insurance. I need a loan to get, better inputs, for my, crops. Then I can manage my risk, or, tell me when the rains are going to come, this year, because it's become more variable. You tell me that, I can manage. So it's much more than just about, I'm going to pay for my crop loss. And I
It
think
is.
that, is something that needs to be, remembered. And I think it has greater value than just that. Yeah.
You just extend that, what you just introduced a nice topic. If you're growing a crop and you don't think you're going to have back-to-back losses, you can recover by having a loan. Now, what we learned in Mongolia is they were much more interested because this was an asset, a livestock, right? And you saw herders get more interested in purchasing the index insurance there because it was truly an asset that they were going to lose if they died.
Yeah. Yeah. Let's see. I think we got a hand raised. Let's see here. I was going to lost where did that hand go?
That was me. That was David.
Oh, David. Yeah.
Jerry, thanks for that presentation. Really enjoyed it. My question is on the parametric insurance side, and I'm wondering if there has been any discussion or sort of investigation of parametric insurance for so-called compound hazards, where you've got multiple events overlapping in space and time. The relationship between them might be complex, or situations where you get two events that occur, I'll say unnaturally close together in time. We plan for, one major hurricane every 5 years, and now we've got one major hurricane every year. And the repeat rate is too small to allow us to refill the tank of capacity to rebuild, et cetera. So any discussion, thoughts on that general topic? Thank you.
Well, I think those are two different questions, just to start. All right.
Yeah, that's good. Yeah.
The multiple peril thing, absolutely. I mean, this is part of the aspiration of the program I'm working with the chief economist here, is those 12 hazards. He's been telling the G7, if we've got 12 hazards, we're going to make it more diversifiable for the reinsurance industry. We're going to make it more attractive to the reinsurance industry. And reinsurers are ready to price multiple peril parametric products. Mm-hmm. So you can do that. There's a lot of different ways to think about how you manage the correlation in the tails of the distribution. And those become pretty sophisticated analytical processes. Yeah. But as you might imagine, reinsurers are up for the game and actuaries are up for the game. I think the other question you ask is kind of spills over into what are we doing as we recognize that there's a greater frequency of things happening, and we do. You see a lot of different things happening there with the market. You see people trying to do trend adjustment. You see them put the thumb a little heavier on the scale because they see things in a different way. This is not all a science. There is some art in this, I've learned. Yeah. And you can see crazy things in some ways if you're academically bent, because you do all this heavy work and you do all this analytical work and you show the trends and you show, you know, sophisticated ways, ARIMAs, all kinds of things. And in the end, the underwriter says, all I want to see is the last 5 years.
Yeah.
Like, what? This is a catastrophic risk. All you want to see is the last 5 years. But there you have it. And it's typically not only I want to see the last 5 years, show me the loss, expected loss for the last 5, the last 10, show me the expected loss for what you've done that's more sophisticated. And then I'll figure out how I make the soup from there, right?
I think this relates to a
Thank you.
question. Yeah. Thanks, David. Good question. Alex got a comment was, indemnity insurance isn't perfect either, right?
Yeah.
You've got, exclusions and sublimits. And so if the contract that's created for the product doesn't align with the risk, you have a risk of not payment, on an indemnity contract.
I'd say there's a lot of insureds that have had big discussions with the loss assessor. They haven't been friendly in many situations. Yes.
And Isaac can ask the question about pricing risk, and this, I think you would be, well qualified for this. It's not just the risk. So, you price the risk of drought, for example, but they're also impacted by the price of the crop itself, right? And so, is there a way that you can manage that through a parametric? So, the drought, caused we have less of maize in our area, but the price went up. So maybe I'm okay. So is that a multiple trigger, or is that, how do you deal with that kind of issue when
It's a
there's
great question. And I think the answer that I've always provided is that the client has to think about the events and the rate of payment. And then they need to step back and ask themselves, how much liability do I need? What protection levels do I need? And if you think you're working in an inflationary environment and you're trying to protect property, and you want to hedge against inflation, then when you sign up for this parametric insurance, you better buy a higher level of protection, because the premium is rate on line times liability.
right.
So
it's customized to the risk you need.
Yeah, but it's a tough one because you're putting a lot more burden on the client to
Yeah.
do some homework.
And the distribution here, I guess, is also important. Who is, distributing it? If you don't have an agent that's involved, in this, to explain, what you just went through, that would make a difference, So
Yeah. Well, there's some questions coming up here on. I see the chat. How do you want to do those?
I think I covered some of those, unless I missed some.
And people can reach me. I'm always accessible if you want to chase me and find me.
There was a message from Janet. Have you been following the livelihood products that the CCRIF has been
yeah.
piloting? Any early lessons there?
I'm excited to follow it more. Yes, thank you. I think it's exactly the direction I would like to see people go in.
Right. Very good. Okay. Well, if we have no other questions, I'm going to thank you, Jerry, for helping us to understand the implications of this, worldwide, and helping to narrow the protection gap. And it's very encouraging and heartening to hear what the potential is for this, and look forward to your additional work in this area and the successes that you have. And thanks for sharing, some of these in the early phases, as well as some of the successes. So very promising. And we're thrilled that you were able to take the time. I know you're in Rome now, and, carving out some time to be with us was really important.
Yeah, I would like to stay for Michael. Michael, I've already told you, I got to go to dinner.
Yeah. So Michael's coming up. Michael McCord will be our last session. at the top of the hour. And Michael will be talking about, the overall kind of expanding on this topic of protecting vulnerable populations from catastrophic losses. So we'll see you at the top of the hour with Michael McCord.